Okay, good afternoon, everybody. Hope you had a good lunch. Topic for the panel for this session, we're looking at strategies for financing shipping cycles and the role of alternative finance. And sort of a specific question we're going to look at is, with so many vessel sectors at the moment remaining strong and asset values high, how do banks and alternative finance providers balance the risk of financing against that asset value and strong cash flow and getting the loan down to historical averages in a timely manner? I suppose first say thank you for the panel for joining us. I'll just go through who everybody is. To my left, I've got Jun-Hyung, who's Head of Overseas Investment Division and Director at KDB Infrastructure Investments Asset Management. Alongside from Jun is James Stove-Lorentzen Jr., who's the managing partner at NorthCape Partners. Next to James, we have Elias Sakellis, who is Chief Investment Officer at Borealis Maritime and Chief Executive Officer at Australis Maritime. Next to Elias, we have Markus Wenker, who is Chief Financial Officer at FSL Trust Management. Next to Markus, we have Peter Wessel-Aas, who's General Manager at Fearnley Securities. And next to Peter, we have Jolene Chu, whose name I've lost on here. No, I haven't. Who is Co-Head Origination and Structuring at Clifford Capital. So welcome, everybody, and thank you for taking the time of the panel today. I suppose first we should look at, alternative finance in the context of its relationship, or I suppose not its relationship to traditional bank debt financing. I suppose traditional secured bank financing has been in decline for some time, with previously large financial institutions having either withdrawn completely or partially from ship financing, particularly in Asia. So first, I think we should probably explore where is new secured debt coming from, in particular for Asia. I think I'll start with Peter on that one.
Sure. Thank you. So I think we all know that over the last decade, there is a significant amount of bank capital that has left the maritime space. I think notably the European traditional lenders have pulled back from Asia. I think according to available statistics, I think some $200 billion have left the industry, and partly offsetting that is bank capital, notably not from Europe, but from Japan, China, and partly the US. Also, the significant part of that gap being filled is partly through equity, but also, of course, alternative lenders, including leasing. As we all know, the Chinese leasing institutions have plugged a significant part of the gap. I think from our point of view, we're seeing the Japanese and Taiwanese market also remaining quite active. But I would say, being the only one on the panel kind of focusing on capital markets, a notable exception among ship owners in Asia has been bond financing, which has been used quite actively among owners in the US and Europe, specifically for the Norwegian bond market, which is a home market for us, also the second largest bond market for the shipping industry. We have yet to see Asian owners tap that market, but of course we hope that changes.
Thanks, Peter. Opening up to the rest of the panel, commentary on that or additions at all?
Yeah, actually, I used to be ex-banker, ABN, and then unfortunately, like many other European shipping banks, they withdraw from Asia, as you mentioned, so we lost the liquidity. But I came back to Korea, and so I'm leading this KDB Kiemco. My function is raising capital from current capital market and then invest locally and then globally. We have $13 billion AUM, and then $3 billion is international business. So a portion of it is shipping. So I think Asian countries you mentioned, Peter mentioned, Japan, Chinese leasing is active, and then Korea also actively supporting domestic shipping community using their capital. Its capital come from commercial LPs, or sometimes come from the government-related agencies. So I think with this domestic support, it's the filling the gap, what we need for the shipping community.
And was that on a domestic basis, or was that internationally looking as well?
Yeah, it's a very good question. Actually, okay, $3 billion worth AUM is all international. So it's majority goes for project finance. It's a power plant, renewable. So what I'm considering, so we need some education to our investors, because they are familiar with those type of project finance, but shipping is still, whatever region, they are very reluctant. So what I'm going to, not now, I'm doing, sell them, hey, this shipping is a kind of infrastructure. For example, we are arranging what big mezzanine trench with the 15 LNG vessels. Its off-taker is one of the leading player from Middle East. So that trench is about $600 million worth. So it's that kind of project. Then we can access indirectly. We are supporting Korean ship owner, but indirectly we are providing liquidity for the shipping community globally. Yeah.
Okay, thank you, Jun. Elias?
Just to go back to one of the things that Peter mentioned, which of course is correct, that the direct exposure of banks to shipping has been decreasing over the last decade. There is a bit of a quirk, which especially the American and the European banks, part of that capacity, it doesn't actually leave the industry overall, but comes at back levers effectively, alternative lenders like us. One of the key reasons why banks, especially in Europe, have been reducing their exposure to direct lending in shipping is regulatory pressures. Shipping, due to its asset class, requires a certain amount of capital to be set aside, et cetera, et cetera. These requirements are not the same if you approach it from a structured financing angle. And so levering lease or loan portfolios that somebody else originates has different capital treatment than when you do it directly. And therefore, they actually do stay involved in shipping in a slightly different form.
Yeah, I think I would second that, but maybe on an even bigger market, which is the Chinese leasing market. I'm not quite sure we can qualify them as alternative lenders anymore, though, considering the sheer size of the market that they've taken in the last 10 years. If we're calling 30% of the entire maritime market alternative lenders, I'm starting to wonder what's alternative. And they themselves do at times use back leverage from international banks. Of course, the majority of the funding does come from within their organization or from other Chinese banks, but they still use a lot of international debt, traditional European banks behind them.
Yeah, I'd agree with that. I think that was something which Peter and I were discussing over email before the conference, and that I was lumping leasing together. But yeah, I suppose it is an alternative product, but maybe we could distinguish it by who's providing it. But you're right. I mean, the Chinese leasing companies it's a standard form of or alternative form of financing now. I think we could say definitely. We have touched on, I suppose, the alternative or different alternative financing products there. But I suppose in relation to Asia, are there, in terms of those products that we've talked about so far, are any of them particularly active more than others? And if they are, is that geographically? Is it particular to a geographic region at all, or is it a bit more random than that in terms of the take-up of those products? I don't know who would like to start with that. Jolene?
Yep.
Oh, you're off. You got the bad mic.
Hello. Oh, there you go. Hi. No, I just have to say a few words about Singapore as a source of financing. We were set up with a very strong mandate to support Singapore-based companies in certain sectors, infrastructure, offshore, and shipping. So definitely for companies that qualify for the Singapore, based on the Singapore substance, then it's something that we'll be very keen to look at. We are looking to see how we can, at the same time, support existing businesses to go towards the whole journey of energy transition. This is a very big term. I think there's been lots being discussed from yesterday. What it really means has also a very, very broad definition. And right now, I don't specifically see a standard in the market as to what exactly qualifies. All I can say is for Singapore-based companies, Clifford Capital is extremely keen to see how else we can support the companies, be it through potentially the uptake of new technologies that are just pre-commercialization, for example, and we look at how you operate your assets, etc. So I mean, we are pretty new in the business. I would say probably about 5-6 years in shipping specifically. We're 10 years old, so it's more than half of our corporate life. So at the end of the day, we are trying to grow our shipping books and trying to make a difference to the industry. That's for Singapore for you.
Thanks, Jolene.
You asked about which market is quite active, and I think one market that we've seen has been very active the last year and a half, 2 years, has been Japan. I think traditionally, especially on the JOLCO side, they focus a lot on the aviation, and let's face it, hasn't been a lot of aviation deals for them to do. And so there's been a great, I think everyone in the room has probably received emails from people trying to, looking for a traditional Japanese sale-leaseback or a JOLCO transaction. So that's one market that we've seen a big uptick in the last 2 years.
And if I can just add to that, because we're quite active in the Japanese market, and I think one of the unique features of the Japanese financing market is that it's quite sticky and resilient capital. So we even closed transactions in just after the COVID-19 lockdowns, when everyone else was just kind of running for the hills. So, and also the reason for talking about kind of lease financing, Japanese alternative lending, whatever it is, the way we see it is if you traditionally have banked on European bank debt, and you then look to refinance with, whether it be Japanese, Taiwanese, Chinese, whatever, it's still a consideration for you to strategically diversify your capital sources. And so, since that's a product we offer, that's we lump it together with alternatives. But I realize that the answer to that question will be different depending on who you ask on this panel.
No, of course. Outside of the JOLCO, I suppose general leasing, I mean, obviously in terms of the Chinese leasing companies, still a very popular product. But outside of sort of the Chinese leasing companies, maybe Markus, I could come to you about sort of just general leasing in the market at the moment in terms of popularity as a product compared to the debt side.
We at FSL have basically been a consumer of leasing, even though First Ship Lease was supposed to be a leasing company. We have pretty much converted into a normal ship owner. And obviously, as it was mentioned already, the Chinese leasing market has become not an alternative source of finance anymore. They have become younger but traditional source of ship finance now. And at FSL, we looked into Chinese leasing ourselves, arranged a lease in 2020. Now, obviously, you see what's happening in China, and that is very worrisome when heads of ship finance at leasing companies just disappear, and ultimately shipping is a people business, and as a borrower or lessee, you want to know who are you dealing with.
No, agreed. maybe we should go more to now addressing the question here in terms of balancing risk of different financing structures for, I suppose, the shipping cycle in general. So how can owners use alternative finance providers or products to balance their financing needs, taking into account the cyclical nature of the shipping industry? So we're obviously looking here long-term, medium-term, short-term. Who would like to have a crack at that one? Markus?
I think I can start. Ultimately, both from a financier's but also from a borrower's perspective, there are two key things where it comes down to, which is one, discipline, and second, defining the risk appetite. And we have now seen increasing asset prices pretty much across the board. And when we look at loan-to-value financing, that basically that translates into, say, a 50% loan-to-value is a much higher loan today than it was 2 years ago or 3 years ago. But the risk, the underlying risk has changed, even though the level of loan-to-value remains the same. So when I was a banker, we had a very clear approach on the cash break-even rate, because this ultimately determines the level of risk. And what we did as bankers, and now what we do as owners, is we look at what risk level in terms of cash break-even rate do we feel comfortable with, irrespective of what the loan-to-value is. And this is something where people need to be very conscious about. Just the fact that market values have increased doesn't mean that we should still take, say, 60% loans, but each and every borrower, as each and every lender, needs to define what is my risk appetite and how realistic is it. And I ran some numbers in the past in my previous life as a banker. When you just backtest your break-even rate with the historical rates, in many cases, when you provided a 60 or 70% financing, there were just very few quarters when the assets were actually earning the cash break-even rate, and that's not healthy for both the borrower and the lender. And this is basically, if you follow that approach, it's destined to go bust, in my mind. So this is something people need to be very conscious about, very carefully looking about. And then there's a second aspect, and that is very relevant in my mind when it comes to alternative finance, that alternative finance providers are often willing to give a high advance ratio, but they still call it senior finance. Ultimately, it's just a unitranche, but it includes an element of like mezzanine loan, even though it's secured by a first mortgage. And this is something where ship owners need to be very conscious about, that this is basically a high-risk finance, depending on where we are in the cycle.
Okay, thanks, Markus. Elias, would you like to comment?
Yeah, look, from a borrower's perspective, obviously the advantage of having more options in terms of your financing palette is that you can access the financing market almost irrespective of where you are in the shipping cycle. And that's a very big advantage for such an asset class, which is both broad in terms of segments, but also large in terms of dollar value. The reason why alternative lenders or direct lenders, like we like to call it, is that the flexibility in terms of structuring. You look at two of our term sheets, and no two of our term sheets look alike. It can be loan, it can be lease, it can be high LTV, it can be low LTV, it can be recourse, it can be non-recourse, it can be accelerated repayment. It can be, a longer profile. So it really fits. It's fit for purpose, and that's something you can do partly because of your unregulated status, partly because of your risk appetite, as very correctly you mentioned earlier. And this is something, and you're right, and we always focus, and you're right, we always, when we analyze a new project, we focus on two numbers. First of all, number one, does the owner make money? Because if the equity IRR won't work, we don't want to do this. We don't want to do this. We want to be aligned exactly because we're taking more risk, either structurally or from a leverage perspective. We want to make sure that economically we're totally aligned. So we only want to finance projects that make sense from the owner perspective, from the equity. Number one, and number two, obviously, it's the break even and how you manage that. The other way that you can consider people like us to be to provide more options is in terms of the scope of our mandate. We don't just do the liquid merchant shipping segments. We do everything, including offshore, including niche segments, MPPs, car carriers, gas carriers, chemical tankers, anchor handlers, PSVs, subsea vessels, you name it, we can do it. It will take a bit of structuring and a bit of thinking, but we can in theory do it.
Yeah, you asked about through the cycles now to watch for high asset prices, and I think when asset prices are rising to the levels that we're seeing now, of course you have to pay more attention to the credit behind and the secured cash flow, right? Of course you can't go. We all know there is a possibility of renegotiating charter contracts. It's not unheard of, but still, when asset prices are high, there's levels of security you can look at, and cash flow, secured cash flows, and who's behind the transaction adds maybe the little bit of security you're lacking to take a punt on a higher asset value.
Yeah, for our client, most of the client placed order against long-term charter recently, so we see less speculative transaction. That sense, even though it's a high cycle, if they have a good trend, the charter or employment behind, then I think still we can support our client. And one sector is not supported by long-term employment is container, but recently one of our big clients paid back mortgage with own equity, a couple of $1 billion. So we don't concern about this is a container owner is a totally different stage. So it's that's it for our client.
I think just one small point to add. At the end of the day, when the market is so high, what we like to see is also to have a little window into the thinking of the management. Ultimately, if a sponsor or an owner is still demanding for sky-high advance ratios, it could potentially be a red flag for us, especially as a senior debt provider. In terms of alternative financing, I wouldn't quite put ourselves in that bucket because people who know us, we are a senior bank-like, even though we're not a bank, senior debt financing provider. And we do, with a very strong narrow focus on Singapore companies, we are also very picky in terms of who we want to support. We have to be extremely sure that the sponsors have the right mindsets. Just because the market is super high, how much are you going to borrow? Are you demanding extremely aggressive terms, etc.? And looking at a company that is predominantly only financed by 90% lease structures, I don't know, that makes us feel slightly uncomfortable sometimes. So it depends on the mix as well of the capital.
And I just want to make one comment because Jun mentioned long-term charters. And we have seen in the past that when there's a down cycle, even long-term charters may not be as secure as people thought. And what we have seen in the last few years, for us, long-term charters are not available across all the different segments. I think this is something very important. You have different segments where you have per se different risk profiles when it comes to the markets. For instance, in dry bulk, you don't get as many long-term charters as you get in containers. However, in containers in particular, we have seen in the last, say, 2 years that many of the big liner companies tanked themselves with very expensive long-term charters, and now the market is declining. And my question to that would be, and we also have a sky-high order book now, so my question to that would be, how sustainable is that? And there's one US-listed company, for instance, that has been very active distributing all the good profits of the last couple of years out to their shareholders, and I don't know how sustainable their business model will be for the next few years if we have new capacity entering the market, while at the same time we may see a recession in some of the major economies in the world.
I think on the average, the container lines have made more the last 2 years than the 30 years combined past. So they're certainly sitting on a huge pile of cash. When we see them buying pharmaceutical companies and newspapers, you know that they're sitting on a lot of cash. And I think MSC is sponsoring Formula One and Premier League now.
And going into the airline business as well, so expensive. Okay, so I think we covered quite a lot just on those on that one question. I mean, we looked at Markus touched on the employment strategy side as well. But I think going back to the question there in terms of how do you manage the risk in terms of where we are in the cycle, it seems to me that what you're telling me is that you're looking more of it, you're always going to look at the credit, but there is more of a focus on the credit themselves as well in this type of environment. Okay, so I suppose let's have a look at the differences in terms of, I suppose, behaviour, in terms of things are going wrong. Is there any difference in terms of strategy, in terms of how you would manage clients in case of problems or issues that come up as a result of these alternative finance products, as opposed to a way maybe a traditional bank financing would act? Don't know who would like to take that one first, maybe Elias?
Sure. Hopefully yes is the answer, and then comes again down to two very simple things. The first one is, again, if you don't have the burden of some form of local regulation that dictates how non-performing exposures, irrespective of how you want to define them, have to be treated, that naturally gives you more flexibility to, first of all, give more time to something. And that is a good place to start. The second thing, which is probably slightly different, but again, very idiosyncratic depending on each of these platforms, you know, I can take ourselves as an example. Our direct lending business sits right next to our equity business, right next to our ship management business, and therefore our underwriting officers are literally 2 meters away from people who look after chartering, who look after operations, who look after technical management. Hopefully what that means, and obviously you have to work at it from a cultural perspective, but hopefully what that means is that you can appreciate a problem better. You can work with a borrower in a slightly different way, perhaps, if you were purely a lending institution and you didn't have that. So hopefully that gives some insight as to how we're thinking about it.
Jolene, was this something you also wanted to touch on as well?
Yeah, just very quickly. I mean, we're in this business for the long run. We would like to think that we understand shipping, despite being not that long as a corporate history, but people in the shipping team, we all really understand the business, and management is always very supportive. So for us, you know, just getting your foot through the front door to be a sponsor, whom we would be more than happy to lend money to, and if the going gets tough, we would also be there to hopefully ride it out with the sponsor, based on a very good relationship, hopefully. Things never always turn out as planned, but as a starting point, it's really about being constructive to the best extent we can.
I think that here there's a big difference between different types of alternative lenders. I think that, as was mentioned, that some alternative lenders have a setup, and probably part of their credit analysis is, if we have to take possession of the assets, how can we operate it technically, commercially, what can we do? And also that the ship owner, when he borrows at a higher advance, you know, also was mentioned, you have to be prepared for it. It's a higher risk. So they're probably maybe quicker to take the asset away from you than the traditional bank, who really doesn't have a setup and can sit on and has to work it out with you for a long time. Maybe more so also in China, they don't, you know, they've all said they can take the vessels, but don't see it too often. And in Japan, of course, you have to travel there and then try and work it out, but they won't take the vessel anytime soon. So there's big differences between, if we classify them all as alternative lenders.
Yeah, no, I'd agree with that. Jun, any comment from you on that?
It's a difficult question. First of all, I don't want to encounter that situation, but
prevention's better than cure.
But I also have many experience involved in Chapter 11 situation, Korean version of Chapter 11 for all days. So it's then first of all, I think we are risking much bigger than senior lenders. So it's active involvement solving the issue will be very important. So it's active dialogue, and then it's a coordination with the senior. Yeah, sometimes we have to fight, and but I think in general we need a coordination. And then if you need, then it's it's restriction. But Korean legal system is very lender friendly, so it's that sense we are a bit convinced. And then that's why we are, as I mentioned, the cash flow, they having long-term employment from strong off-taker. That's very important because that's a really important security for us.
Okay, thank you, Jun. Let's continue looking at maybe some of the key differences between alternative debt and secured bank financing. How do I don't know to what extent you would like to comment on this, but how do the rates for alternative financing products differ as compared to secured debt? Obviously, we're looking across different types of products, but how does cost generally compare? Elias, would you like to kick off?
Okay, obviously, on average, we're talking about, on average, we're talking about more expensive capital for obvious reasons. The funding sources of a bank and the funding sources of direct lender are slightly different. So that has to be reflected. Having said that, what's interesting, especially in the current environment where you have base rates increasing so much and so quickly, what you'll find is that most direct lenders are targeting absolute returns, not relative returns, and therefore you'll find that their margins today are significantly lower than what they were a couple of years ago. And in fact, most of the time they're probably not that much more expensive than a bank who would lend, again, on a non-recourse basis. I'm not talking about a bank that would lend to a very large corporate, ship owner, et cetera, but a bank who would be willing to lend on a non-recourse project basis, you'll find that it's not much more expensive than an alternative lender in the current environment.
To add to that also, you have to remember that if you're doing 60% from a traditional lender and you're doing 80% from an alternative, the 20 could be viewed as, or should be viewed as equity or mezzanine. So the combined cost, it needs to be done on a total basis, not just what the senior is.
Yeah, understood. Peter, any comments from you on that?
Yeah. Sorry. Yeah, I can add to that. So obviously our role as an investment bank and an originator, we cover the whole range. And actually what we've seen from our point of view lately is that, in fact, some of the alternative lenders in Asia is actually competing with banks also on margins. So we're working with, that side of the spectrum where there are alternative lenders extremely competitive on margin. We are working with, hybrids with equity features where the price tag is obviously much higher, and everything in between. Bonds tend to fall somewhere in between. Of course, we're working with Elias and his peers, and I guess the key difference to think about in terms of rates is that they have a return hurdle to give their investors, but they can also compete on other arenas and other terms that traditional lending can compete on. For example, residual value risk, and I'm sure we'll get to that later. But that's something to keep in mind, and it's a commercial consideration for ship owners.
And one more point, sorry, on the overall economics and how do you analyze a project economically. And the margin, the cost of capital is obviously very, very important. But the other thing which is very, very important is the free cash flow to the equity. So we come back to the cash break-evens. And again, even before rates did what they did, on average, we found for like leverage, not for a different type of leverage, but for like leverage, our break-evens were always lower than that of the banks because our profiles were longer, because we were willing to accept bigger residual value exposure. So it's a slightly more sophisticated or complicated than just what's your margin.
And speed is key. You're fast.
Got it. Okay, Andrew, we got time for one more question, or? Okay, Peter, you touched on residual values there, particularly in light of upcoming environmental regulatory change. I suppose how can this be effectively managed? I suppose that's a question not just for alternative finance providers, but for finance providers generally.
I can start. I think from what we are seeing, traditional lenders or interest from traditional lenders typically taper off when a vessel hits around 10 years, plus minus, and of course there are exceptions. But Asian lenders tend to push that out a bit further. But then again, they typically are not taking straight asset risk. They will take a credit risk. So it's not directly comparable. So what we're seeing is when it comes to end-of-life financing, etc., it's essentially alternative lenders like Australis or the bond market, investors that are able to take a purely economical approach to how we can put together a structured deal so it makes sense for both the owner and for the investors.
Yeah, and I think alternative lenders do this well. They can price asset risk and the potential in the market and potential in their clients. But I think what we see out here in Asia is that you can get these types of transactions done with longer profiles in Japan. You can get it done in Taiwan with some of the special lenders there, and for sure in China. I mean, that's been the biggest market on that type of financing and complicated transactions such as FLNG and cruise and such. That's also been the big market for us in China.
Okay. Any sort of final comments on that from the residual value side or pricing? Doing anything from you at all? Maybe on pricing at all?
Yeah, difficult. Yeah, this is actually the big concern. We have to consider that now we are financing LNG vessels. We saw the development of technology, first, second, third generation. Is it the end of it or fourth generation comes up? So yeah, then but there is no one can have a crystal ball. So we rely on the. Again, I have to say the cash flow from the off-taker, then we have to rely on that. That's the best way at the moment we can rely on.
Okay. Andrew, shall I throw it open to the floor? Questions, observations from the audience at all?
Any questions? I was just wondering, because alternative lenders will probably be more likely to be lending to SMEs, certainly in comparison to banks, right? And these SMEs may be less likely to be investing into vessels with alternative fuels or green fuels. So, because they're smaller, they're not going to take that risk as some of the larger ones. So how would you see in the years coming that you're going to evaluate those vessels that may not be may not have such a long life, given that they're not going to be greener fuels, alternative dual fuels? Just wondering your thoughts on that.
Sure. Obviously, it's a very good question. I'm not sure I would say that. Again, depends on how what you classify as alternative lenders, because I'm pretty sure that most big leasing houses in China would be willing to finance new building projects of new propulsion vessels, etc., etc. But that also applies to many direct lenders, to be honest with you, and each one have been able to raise a slightly different type of capital with a different mandate. The bigger question, of course, that you're asking is, again, the right one, which is irrespective of who you are, what type of financier you are, how do you look at residual value risk in terms of traditional propulsion versus some form of dual fuel technology? And this is a very, very big question mark. You will find many people who will even tell you that dual fuel LNG has big stranded asset risk because it's going to be caught in the middle at some point with even more carbon-friendly, propulsion technologies. Overall, we also have to reflect on the fact that this is a massive, massive fleet. This is a very big asset class, and none of this is going to happen tomorrow. It's going to happen, but it's going to take time. It's going to take 10 years, 20 years, maybe more. In the meantime, one of the most economically and ecologically friendly thing we can do is extend the life of existing assets without taking undue technology risk on new assets that may become obsolete quicker than people think, until it's very, very clear what wins, in which trades, in what circumstances, et cetera, et cetera. Somebody will have to continue financing the existing $1.5, $2 trillion fleet, which is on the water today. So this is not going to go away anytime soon. The question is very, very valid, and we all, I'm sure, are struggling with it every single day in different ways and different forms.
And the smaller ship owners may not be the ones that focus most on it, but they also might be the ones that actually focus most on it. Startups that actually pick that part of the industry to target, and their access to cheap capital may not be there. So maybe it will be alternative lenders that has to take part of this $1.5 trillion of capital has to come from somewhere. Of course, traditionally, capital from alternative lenders is a little bit higher. There's some equity play in there, something like that. And if you're a startup, that's the type of capital you have to go after.
Okay, well, thank you very much, everybody, for contributing to the panel, and thank you, Marine Money.